All right, welcome everybody. Welcome to my channel, The Financial Trader's Mindset. It's been a while since I've done a video. And this one is going to be more on just the mindset of how you have to think when investing in the markets, right? When you're investing long-term, because see, most people shouldn't be trying to time the market. Most people shouldn't be trying to extract and find where they should get in, where they should get out. Most people lose at that game simply because they just don't have the emotional discipline to stick to their guns or stick to their strategy consistently day in and day out, right? That's why most day traders fail, right? They just can't hack it, right? It's a lot of emotional roller coasters and whatnot, right? But anyways, okay, so what is the alternative? You find quality assets that you want to buy and that you want to own and that you want to accumulate at lower prices and distribute at higher prices without trying to time the market. So how do you do that? Well, here is what you see here are my wallets filtered by Ethereum. Here, I'll even show you. This is using Metrix Finance, by the way. It's freaking fantastic, right? Like I used it before, but it wasn't really working for me, but now it's working. It was just fantastic. And it shows all the data you need. You can put multiple wallets in and you can show your performance across all the wallets, which is fantastic, right? So I'm going to filter by, this is like everything, but it doesn't show my Radium. It doesn't support Radium yet. So he's working, and Jake is working on it at Metrix Finance. So that's a big one for me as well. Radium is pretty big. But yeah, it supports Uniswap, Orca, Aerodrome, Velodrome, QuickSwap, and I think there's one more in there. But yeah, all pretty much the major ones, right? So I'm going to just filter by Ethereum because what I want to show here is because I'm a big Ethereum, I'm pretty much an Ethereum maxi, right? I own Ethereum on the chain. I own Ethereum in my brokerage. I own a lot of Ethereum, right? But what I want to show here is that if you want to accumulate, let's look at Ethereum, right? If you want to accumulate Ethereum and be incentivized to do so, using concentrated liquidity is a great way to do it. Now, you don't have to try and time the market or whatnot, whatever, right? If you just feel prices are getting lower and lower and you want to accumulate at those prices, you can do that. And that's exactly what I do. And when I accumulate, like say, for instance, here in December, when we topped out again at 4,100 and came all the way down to 1,385, that's a big drawdown, right? Most investors or most people would buy the top here because they're like, oh, wow, it's breaking a new high. So it's breaking out. Let me just jump in. That's how most people think. They're like, I don't want to miss, they get FOMO. They don't want to miss the run. And then as the market comes down, look at that volume. Volume here, volume here. People capitulate and just throwing in the towel. They're like, you know what? I don't want it. It's too cheap now. It's funny how the psychology thinks, right? It simply comes from a sense of scarcity, right? You know, when the markets are ripping higher and people are excited, people are like, oh my God, I don't have enough. I'm going to miss the run. So they jump in and they FOMO in. And then when the market's tanking, everyone's freaking out and fearful. They're like, oh my God, is this thing going to zero? I don't want to lose all my money. Scarcity mindset. They dump all their Ethereum. That's how the average person thinks. And that's why the markets are the way they are. That's the nature of the markets. The nature of the market is it's kind of like a fundraising system, right? They want to extract your money, right? To enrich in the project. It's fundraising. So it benefits the project if you buy high and sell low, right? Because then they get to buy at the cheap and then distribute to you at the high. So how do you play this game? How do you get on the right side of it without having to worry about trying to time the market? Because most people, if 99.9% of people cannot time the market, you're playing against the Michael Jordans of the world, the institutions, the hedge funds that spend hundreds of millions of dollars or even billions of dollars a year hiring, super smart geniuses, quants, people that have strategies, that use algos, that use, they use AI, right? Like it's like you showing up to battle with no weapons and you're fighting the Terminators. That really is what it is, right? If you don't know what you're doing, and if you make money, you're just lucky, right? You just got lucky. There's a graveyard of bodies that don't make it. All right. So how do you approach this? What do you have to do to benefit from this market? All right. Well, let's take, for instance, in December when we topped out. I use my liquidity pools to accumulate and distribute, but I always keep a core position so I prevent that FOMO. That is the basis of my strategy. It is very simple. I'm not day trading daily. I'm not trying to buy and sell the market, trying to buy the bottom, sell the top, right? It's simply like, actually, like my crypto portfolio is more like a long-term investment. And then I find ways to generate yields on top of that so I could have returns like this, right? I can earn $184,000 in yield while the market does what it does, right? Like look at the price of Ethereum. It's pretty much like, if we go on the weekly, pretty much flat for years, multiple years. If you were just holding, not earning any yield, you'd be hating life. So what I do when the market was down here in 2024, I was accumulating Ethereum from the 2024 top in March. I was farming liquidity pools, generating high yields. Market wasn't going higher. I was positioned to go higher if it wanted to go higher, albeit I didn't have as much as I wanted up here, but still I was mitigating risk. And I had stable coins to buy the dip, which it did. And then we rip higher. I distribute using liquidity pools. It does it for me. I don't have to like time the top, right? Up here, I was around 35% cash. I'm like, I was even getting FOMO. I was like, man, I don't have enough. I think this might rip. I thought it was going to rip too. I thought it was going to go to new highs. I thought it was going to 5K, but it didn't. And that's the risk. I look at it here. I'm like, well, the market has went up almost a double, right? Like that's a big move. Even though I have FOMO, I just stayed disciplined. I'm like, you know what? Why? This is what kept me disciplined. When I had my liquidity pools were selling Ethereum consistently on the way up. Now, logically, why would I want to take all the stable coins that I sold my Ethereum into as we're going up at lower prices, and I'll take all my stable coins and then buy Ethereum back up here? Why would I sell down here if I was going to buy back up here? Makes no goddamn sense. That's selling the bottom, buying the top. Okay? So if you take that logic in mind, you could use liquidity pools to automate that system, right? Of accumulating and distributing by setting appropriate ranges. I don't care about the APR. The APR, the yields will come. Yields will come. And there'll be times where you have high spikes in yield, like on August 5th last year during that Japanese carry trade crash. You see that volume? I was seeing over 3,000% APR on Ethereum. The yields were insane. During Trump's meme coin launch, when everybody was dumping all coins in Ethereum and going to Solana to FOMO into the Trump coin, I was seeing high yields, like over 1,000%. That's what I'm talking about. I stay positioned in the market consistently, 24/7, 365. I'm always in the market, consistently generating yields over time. And that's the result, right? You don't get that result from trying to time the market, from staying out of the market. Because if you're trying to stay out of the market and trying to time it back in, you see this Japanese carry trade crash over here, you see the market crashing, and you're like, oh, screw that, I'm not going to jump in, right? It's just natural. It'd be very hard for most people to jump into that. Instead, you just stay exposed, mitigate your risk by position size, stay small enough so you don't freak out. Don't leverage too much if you like to use leverage, but you stay in the market. You can't time this event. This just happened in an instant. Like within the day, couple days, it was back to normal. You would miss that trying to time it because I think it happened overnight. So there's no way. That's the thing. You stay consistently in the market on assets that you really want to own, that you have conviction on, true conviction. That's an edge right there, right? The second one is just to stay in the market, time in the market. It beats timing the market. That way I don't have to sit here day in, day out. I manage these liquidity pools every once in a while, right? I don't manage them too often. They just sit there. They just earn yield. Like I have this one going on right now. Let's see if it loads up. There you go. Let's see. I just put this on last night. Already $65 in yield since last night. Not even like 12 hours. Well, probably about 12 hours now. Put it on around midnight last night. 12 hours, $65. That's like $130 a day on $27,000, right? And then just think about that, like over and over, day in, day out, trickling in. The money's just trickling in. The yield just trickles in, right? Now you're probably wondering, well, yeah, but if I'm in the market 24/7, I have to endure these crashes. What do I do then? You stay small enough. Don't expose yourself to the point where you're going to freak out when the market goes down. Plan out. Say, okay, if the market goes down, I want to buy more here. So I'll set my liquidity pools to buy the amount that I want in that range. If it starts breaking lower, I need to rearrange or maybe go wider to reduce the frequency at which I buy. And the whole time you're earning yield on top of that. And what happened when we got down here? I was starting to leverage. I was using Aave at 2,200. I started borrowing against my spot Ethereum that I was accumulating on the way down, lent it out, used the loan to buy more Ethereum in the same manner. Because now because when I was going down and down, I had to go wider and wider and wider as price kept going down to allow, one, for price to stay in my range. That's why I had to stay wider. But two, I had to stay wider in order to not have any impermanent loss in case the market wanted to rip higher. I would be wider in range. So when the market rips up, I would sell less Ethereum on the way up than I was accumulating on the way down, which means higher profit, right? That's the impermanent gain. That's the opposite of impermanent loss. I like to be an impermanent gain. That's what I always position for. I don't position because of yields, how much APR I'm going to get. Sometimes I do, but not for the most part. I don't worry about APR because they come. And as I was leveraging up, I was using that loan to accumulate more ETH. And when we got down here, like I was parking the loaned ETH back into Aave just to keep my health factor, reasonable, because it was starting to get dangerously low, right? Like I was like getting closer to liquidation because the value of my Ethereum was going down compared to my loan, right? So I took that Ethereum, parked it into Aave to mitigate that risk. And then I essentially am leveraged long Ethereum. And then as price shot up, all that Ethereum in Aave blossoms in value. Smashed it with profit. Now that we're up here at, 2,400, 2,500, I'm in huge profit because I have all this Ethereum that was being accumulated in Ethereum pools or in liquidity pools is in spot. So I rode all the way up in spot, right? Not only that, but I earned yield the entire time. I wish Jake had a way to put the date range on here, but it doesn't. So I let him know. So hopefully he'll add that soon, right? And I'll be able to show it in more detail. But that's just showing I just want to really showcase. You don't have to sit there and try to time the market. I barely manage this. In the past, I ran my wallet, my liquidity pools, all the postings I do on, I just post about all my positions. I ran it through ChatGPT. It says I managed 66 times in the past 13 months. That's nothing. You can do that in your sleep. You don't have to sit there and time the market. And a lot of times, sometimes I just use Aperture Finance to rebalance. That's even some automation right there you can employ. You use Metrix Finance to forecast your yields. I got a video on that. Go check that out. But you can forecast where you're going to rebalance, right? And exactly how you need to rebalance and what range you'll need to be in when that price hits, whether it's on the downside or upside. And then plug that into Aperture Finance. It'll do it for you. Fees will be low because if you're like me and you like to be an impermanent gain, you're not going to sell off any of the assets. You're just going to rearrange it. You keep the assets you accumulated and you rearrange wider. You don't have to sell off anything. So I just want to leave you with that. If you're interested, if you're wondering man, how can I do that? How can I earn, how can I earn while the market just goes sideways? How can I earn money? Like in this chop here last year, I earned so much yield. The hodler didn't earn shit. They're not even break even right now. So if you're like, okay, I hold Ethereum or I hold Solana or even I hold Bitcoin, I want to earn some yield. I know how exactly to do that for you. So if you're interested, I'm actually about to launch my mentorship course where it's a one-on-one where I handhold you from start to staking and show you all my tips and tricks, how to avoid slippage, how to maximize the amount of money you get to keep in your pocket when you transact, when you do swaps, because we all know there's a lot of slippage in DeFi, right? The liquidity is not that deep, but I have ways to show you how to battle that, how to keep more money in your pocket, how to avoid, predatory fees from platforms, how to find liquidity pools to jump into, right? Like here's an example right here. Like I use this one here. I use Mango Pools. You can find a link in the description. I say this is probably one of my top tools right here. If I'm like, okay, where is Ethereum? Where is Ethereum best staked on? I don't like Camelot, Shadow Exchange. I think they have you gotta lock up. So these are just automatically disqualified because Camelot, they do automated rebalancing. I don't like that shit. That's a lot of impermanent loss. But here you go. You got Trader Joe here. Arbitrum on Trader Joe. Well, look at the liquidity. right there. You could always say, avoid that. Base, Aerodrome. That's doing pretty good. Arbitrum on Uniswap, right? There you go. You know, you want to see if the liquidity and volume is good enough as well. You could have this all in the glance. At a glance, you don't have to like guess. There's so many DEXs out there and so many opportunities, right? Incentives out there that you can take advantage of. You need to use these tools to reduce the amount of time that you need to take to just like manually search this shit. Like if you went on Uniswap, you had to go on Uniswap, you had to calculate on each chain which one is better, which one's giving more, you know, paying more yield, which one's more active, right? Because trading fees is what generates the yields. And if you can find this on a glance, it's worth the money in itself, right? It's super cheap. I think it's worth it for anyone that's a liquidity provider, you know, by far. This is my top tool. And also Metrix Finance to track, to forecast, to set up your liquidity pools, you know, because speed is the name of the game. Like speed and just getting the shit done and then getting on with your life, enjoy your life. You know, why sit here all freaking, like to do this and find these liquidity pools, you know, would take me all freaking day. It used to take me all day. I would be here like many hours per day, just looking, you know, analyzing liquidity pools, trying to find the best one with the best returns. I don't have to do that anymore. I just look here, I punch it in. I'm like, okay, which one's the best chain to be on? Okay, that one, let me bridge over, stake it, done. And before that, I plan it out on Metrix. That's the idea, man, or woman. So, but anyways, I'm launching a mentorship course. It's gonna have 4 hours of video content on concentrated liquidity, on the mechanics, on all the pitfalls to avoid, how to maximize your returns, how to avoid impermanent loss, how to position the mindset of a liquidity provider. It's all based on concentrated liquidity. Probably the most detailed course out there on it, right? Not only that, but you get 24 calls one-on-one with me. So 2 calls a week every month. And we go over your portfolio. I analyze your portfolio. I make strategy suggestions like, okay, well, you could probably have a little bit, you could probably maybe mitigate risk this way, or expose yourself more to the asset this way, or you're rebalancing too aggressively here. You know, it's just coaching and getting you in the mind frame of understanding what you need to do, right? So you get that. You get free access to some of the tools I use, right? That's included as well. Check out the course in my description. In the bottom, it's in the link tree, so you'll see it. It goes to my WAP, so you'll see it, and then and there you go. So if you're interested, check it out. Let me know. If you have any questions, post them in the comments below. I'll be happy to answer them. But yeah, it's been long overdue for a video. I need to do more, so expect a little bit more in the future. All right, guys, take care. Don't do anything stupid. Just chill, invest. You know, you don't have to time the market. Not everyone's designed to time the market. Your path is probably something better than just trading the market, right? You don't have to worry about this shit. Just let the market do the work. That's what I do. All right. Peace out. Take care.